All right, hi everyone. Welcome to today's live trading session brought to you by IronFX. Right, as usual, before we start, please take note of the risk warning and the disclaimer. Right, all the products here are traded on margin and carry a high level of risk, and it is possible to lose all your capital. Also, take note that the information in this webinar should not be considered as investment advice or an investment recommendation, but instead just educational material only. Right. My name is Ketan Ramesh Chandra, and this webinar series is brought to you in a special partnership between IronFX and Everest Fortune Group, where we have been the finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. All right, before we dive into the charts and trading view, let's take a quick look at what's left on the economic calendar for the rest of this week. Right, we had FOMC yesterday, as well as the US CPI data, right, which created a lot of volatility in markets overnight. Right, and today as well, we've got US PPI data and unemployment claims, which are bound to add further volatility or inject further volatility into markets. And of course, coming up tomorrow on Friday, we've got the Bank of Japan releasing its monetary policy statement, as well as Governor Kazuo Ueda delivering his press conference. Right. So here's the calendar for this week, or rather for Thursday and Friday, right? Take note, I'm on GMT time. So core PPI and PPI is going to be released at 12:30 p.m. GMT time, along with unemployment claims. And also tomorrow, we've got the release of the monetary policy statement and the press conference as well by the Bank of Japan. Now, take note, this is has been highlighted as a tentative timing because the Bank of Japan does not like to provide a specified time to the media or to the public rather as to when it will conduct its press conference and the press release of the statement. But usually they do tend to release it around 3 to 4 a.m. GMT time, followed by the press conference, which usually starts 1 to 2 hours after the policy statement has been dropped. Right. Now, let's just take a quick look at the FOMC meeting, right? So basically, this is the opening statement by Chairman Jerome Powell during his press conference, right? So you can see here the Chairman Powell, along with his other FOMC members or policymakers, are looking to focus on achieving their dual mandate goals of maximum employment and stable prices, right? So the economy has made considerable progress towards this goal over the last 2 years. The labor market is still pretty strong, right, with job gains and a low unemployment rate, while inflation has indeed eased substantially from a peak of 7% to 2.7%. But of course, it is still too high. And also, we did see inflation, at least CPI and PPI, accelerate in the first quarter of this year. But as we saw in yesterday's latest reading, like CPI data for the month of May, we have seen now softer inflation as well. Now, perhaps this is likely to continue in the next few months, and should that happen, we are likely to see that first rate cut take place sooner than later. So for now, markets are pricing in about, I think, about 55% probability of that first rate cut occurring at the September FOMC meeting, right? And of course, should we see inflation continue to moderate lower, that probability for that September rate cut is likely to increase as well. All right. Coming back to the slides, right? So we've got PPI data due for release today at 12:30 p.m. GMT time. On the left, I have the chart for headline PPI, and on the right is the core PPI, both on an annualized basis or year over year. As we can see, in 2024, we have seen not only PPI but CPI accelerate as well, right? So this acceleration raised some concerns for policymakers, as this would, and it also caused concerns for investors and traders, as it would mean the Fed is forced to hold rates at current levels for an extended period rather than moving forward with rate cuts. Remember, at the end of, not at the end of December, but at the end of 2023, at the December FOMC meeting, the Fed had a projection for 3 rate cuts for 2024. Now, we're already in the middle of 2024, and we have yet to even see the first rate cut or get a hint of that first rate cut. So this acceleration in CPI and PPI was indeed a major concern for policymakers. Now, what is promising is the May CPI data that was released yesterday, where we saw both headline CPI and core PPI come in lower than the respective forecasts. not and coming in lower than the previous month's reading, right, on a monthly and annualized basis. So essentially, it was a soft CPI reading, which caused the US dollar to sell off very sharply uh, yesterday. However, as we headed into the FOMC meeting, the press conference, the statement and press conference by Chairman Jerome Powell was deemed to be pretty hawkish, and that caused a reversal in a lot of the earlier price action for the dollar, and also for gold prices, which we will see in the charts on TradingView. Now, coming back here to tonight, we are seeing the forecast for core PPI and headline PPI coming in lower than the previous month's reading. So that's great. We're expecting these two data points to rise at a slower rate. And should we see the actual result come in line with the forecast or perhaps even lower than the forecast, that would likely suggest that PPI on an annualized basis is also probably going to stall and decelerate as well. So that means we're likely to see the dollar sell off once more, just like how we saw during the release of the CPI data yesterday. Now, at the same time, we also have unemployment claims that are due for release. As you can see over the last two weeks, unemployment claims have started to trend higher, and they've also come in higher than their respective forecasts. Now, when you see unemployment claims trending higher and coming in higher than the forecast, this signals some potential weakness in the US labor market, because as claims are rising, more people are beginning to lose their jobs. Now, that would then cause the US dollar to lose some steam or pull back in price as well. Right. Conversely, when you have a scenario such as this in the second half of 2023, where we saw unemployment claims trend lower, and not only did it trend lower, it was coming in lower than the forecast, right? We can see the forecasts are the orange bars, the blue bars are the actual results. So when you have that scenario or that environment where claims are trending lower and at the same time coming in lower than the respective forecast, that is usually signals that the US labor market is robust, and then in turn would cause demand for the US dollar to pick up. But now it looks like we do see unemployment claims starting to trend higher, and this could gain traction tonight as well. Right, so last week's figure came in at 229,000 claims, and this week we've got an estimate of 225. Now, when we look at the 4-week average for claims, it currently stands at 222. So this current forecast is already higher than the 4-week average. So that means we are quite likely to see this trend continue to grow higher. Now, how can we simply interpret the data? Right, so remember, if claims come in more than 225,000, which is the estimate of forecast for this week, that means there are more people filing for claims, right? They're filing for unemployment claims. That's negative. That's going to be negative for the US dollar. So that means it's bearish. So naturally, currency pairs like the euro, pound, Aussie, Kiwi, along with gold, will rise. Conversely, if claims come in less than 225,000, this is going to function as the bullish. This would typically function as a bullish catalyst for the US dollar, and of course, that would mean currency pairs like the euro, pound, Aussie, Kiwi, along with gold prices, are likely to fall. So take note, we've got the forecast of 225,000. We've also, this forecast is also higher than the 4-week average, and we are also starting to see a potential uptrend in claims as well. Right, and finally, on Friday tomorrow, we've got the Bank of Japan that is going to release its monetary policy statement, followed by the press conference by its governor. Now, once again, we don't know what time exactly is going to be released, but we can expect the statement to be released at around 3 to 4 a.m. GMT time, followed by the press conference, which usually commences 1 to 2 hours after the statement is dropped. Now, the forecast is expecting, or the market consensus is expecting the Bank of Japan to maintain its key policy rate at 0.1%. Remember, at the previous meeting, it increased its policy rate from negative 0.1% to 0.1%, raising it by 20 basis points, right? However, for now, it looks like they're going to, markets are expecting Bank of Japan to keep rates on hold. And should that happen, this is likely going to function as a bearish catalyst for the yen, right? So the Japanese yen is going to come under selling pressure. That means the currency pair dollar yen is likely to spike further tomorrow, right? So take note of that, right? Part of the reason why the Bank of Japan is unlikely to raise its key policy rate tomorrow because when we look at inflation, right, but specifically CPI data, headline CPI, which is on the left, and core CPI, which is on the right, both of which are highlighting the annualized reading or the year-over-year reading, we can see that after accelerating in February of this year for both headline and core, we are starting to see a slower rate of increase in inflation in Japan, right? So this is both for headline CPI and core CPI. So if it does look like inflation is continuing to moderate lower, it means that the Bank of Japan is less likely going to increase its policy rate. Right, remember that's tomorrow. Okay, now let's dive into the charts of trading view and we'll start the analysis on the dollar index. Right, here we are on the daily time frame. And if we zoom on down into the 30-minute time frame, we can see quite clearly how the release of the CPI data and the impact of the FOMC statement and press conference created or injected huge volatility into markets as well, right? So we can see here, this is 12:30 p.m. GMT time, Wednesday, 12th of June. This was when the CPI data was released, and it was a very soft number, which caused the dollar to sell off quite significantly, right? Not only did it sell off here, we can also see that it had closed this gap as well. Now, dollar index was trading at around 105, and it swiftly dropped as low as 104.25, so dropping about 75 pips in a process of about what's this 2.5 hours. However, remember the FOMC statement was released at 6 p.m. GMT time, followed by Jerome Powell's press conference at 6:30, which caused a strong reversal in the dollar index, right? Remember the statement and the press conference were deemed to be very hawkish, which caused this strong reversal here. Although prices have not recovered, right? The dollar index has not recovered to climb back above 105, but we can see that the impact that the FOMC statement and press conference had on financial markets and particularly the dollar index and gold prices as well. All right, okay, so now with that, let's move on over back to the daily time frame and start the analysis for today. Right, looking at it here, right, the dollar index was actually trading in a nice bearish channel since the 1st of May, but we saw it break out of it last Friday, 7th of June. Now, what happened last Friday? If you all remember, we had very strong set of non-farm payrolls number, right? We had a blowout at non-farm payrolls number, which caused demand for the US dollar to surge. So that, of course, which is going to going to lead the XY to bounce strongly on and or spike as well. And we saw it break above this upper trend line of the bearish channel, and it continued rising earlier this week as well on Monday and Tuesday before significantly reversing on that soft CPI number. However, remember, in the latter part of yesterday, FOMC was on hand, and we had the statement and press conference that reversed a lot of the initial moves. Now, we have seen the dollar index find support just above the bullish trend line of this, not bullish trend, has found support just above the upper trend line of this bearish channel. Now, today's data is just as important as well. We've got PPI data and unemployment claims. Remember, if PPI comes in soft and if unemployment claims comes in higher than forecast, that is quite likely going to function as a bearish catalyst for the dollar. So that would mean dollar index is likely to reverse and continue its downward trend. Right, so take note of that. If we get a soft PPI number combined with higher claims, this is likely going to be bearish for the dollar. Conversely, if the opposite happens, then it's quite likely that that set of results would function as a potential bullish catalyst. Okay, now we can see that the dollar index has found a nice support level here. I see a nice pullback support level here at 104. This level has been in place since 26th of March, right? We can see it's in 26th of March has bounced off this level several times, creating a nice pullback support level here. And in mid-May as well, we see a nice swing low bounce take place here as well, just slightly above. And of course, we see like a double bottom here on the 3rd of June, and the 7th of June as well. So you can see very clearly, this is indeed a very significant level for the dollar index at 104. It is a pullback level, and we are going to use this to identify our first major support. Right, when it comes to resistance, we can see dollar index making this high on Wednesday, right, with the top of the wick climbing as high as 105.46. Generally, we can see this is a nice pullback resistance level here that's been in place. Alright, I'll take it here from the top of the body here. That's been in place since the 9th of May. So I'll identify 105.52 as my first major resistance. And I just like to highlight this as a zone here as well, because we can see some resistance at around 105.40 to about 105.50. Right. We can also draw a Fibonacci retracement starting from here. This swing high, oh sorry, this is the absolute high, right on the 16th of April, down to the absolute low, which is here on the 7th of June. I believe there might be a 61.8% Fibonacci retracement. Yes, there we go. We have a 61.8% Fibonacci retracement that aligns with this pullback resistance level here. Or actually, if I were to just pull it back here, you can see here, stretch it all the way till 25th of April. It's actually a very nice overlap level here. We actually have a very nice overlap resistance at 105.50, which also has the presence of a 61.8% Fibonacci retracement. Now, why this resistance and support levels critical? Because after seeing this bullish breakout occur on Friday, right, and if we had jumped in on going long on the dollar index on Monday, right? We had 2 strong days of strong bullish continuation, right? We would have used this zone here, this level here at 105.50 as a potential take profit zone, right? So as prices broke out of this bearish channel, triggering a potential bullish breakout, we would have identified a suitable take profit level at around the 61.8% Fibonacci retracement, basically at around 105.40 to 105.50. Remember, take profit levels would be ideally identified about 10 pips underneath a major resistance. So in this case, the major resistance was an overlap resistance at 61.8%, which is at 105.55. So we would have identified that take profit level at about 10 pips underneath this level of 105.55. And as you can see here, yesterday's strong CPI or soft CPI number caused a strong reversal in the dollar index, and you can see it drop very significantly, right? Diving very significantly. So that's why it's important to identify significant resistance levels, because we can then identify a suitable take profit if we are going to go long. Now, similarly, if you're going short on the dollar index, right, let's just say we get a set of data that's going to be bearish for the dollar index today, and we see this bearish reversal take place, we can see that the dollar index has actually bounced off a pretty decent overlap here, right? I would identify this level at 104.30 as an intermediate support level. So should we see a bearish reversal take place, I would identify my take profit level, or at least the first take profit level at this overlap here, which is at 104.30. And then should we see the bearish momentum continue even further, then I would definitely identify the next take profit level slightly above 104. So maybe about 104.10. Right? That's if we see a strong bearish reversal for the dollar index and we see it drop towards the first support. Conversely, if the data comes in to be potentially positive for the dollar index, we may see a bullish bounce for the DX, not for the dollar index today, extend even further. And then I would use this resistance zone, which starts from about 105.28, to identify that suitable take profit level for any long trades, right? So this is why it's critical to identify significant resistance and support levels so that we are able to identify realistic take profit levels that are going to help us increase our probability of a successful trade. Right, these are the key levels for the dollar index on the daily time frame. And I'll just identify the second resistance and second support, and then we'll dive on over to the 4-hour chart before moving over to gold. And of course, we look at dollar yen since we've got the Bank of Japan lined up tomorrow. Right, looking at the second resistance, it's quite clear. It's going to be around this level at 106.37, right? We see a very nice double top here, right? This is pretty much a double top that has taken place first on 16th of April, then again on the 1st of May before beginning on this downward trend. So, right, we see very clear multi-swing high resistance here. So quite clearly, second resistance is at around 106.37. Right. We can also run a Fibonacci retracement for this uptrend here, beginning from this swing low on the 8th of March, going up to this high here on the 16th of April. We can also see that we have the presence of a 61.8% Fibonacci retracement that aligns very well with this pullback support at 104. So this adds further significance to the strength of this pullback support level here. Now, let's pull up the 78.6% retracement as well and see if it aligns well with any other pullback supports. Right, we can see here the 78.6% Fibonacci retracement aligns very well with this pullback that occurred on the 31st of March as well. So this is where I would identify the second support for the dollar index. Okay, let's zoom on down to the 4-hour time frame and see if there's any need to fine-tune the analysis. No, probably not. I think this is probably good enough. If anything, I'll just adjust the intermediate support level for it to begin from Thursday, 6th of June. We can see a very nice overlap here as well. So should we see this bearish momentum for the dollar index continue, this is where I would identify my first take profit zone. So this overlap level here is at 104.28. I would identify a suitable take profit at about 10 pips above this level. So that would mean my take profit would be identified at around 104.38. Should we see this bearish reversal continue? Right, so the first take profit level would be around 104.38, and the second take profit level would be identified at around 104.10. Right, so these are the key levels for the dollar index on the daily and 4-hour time frames. All right, then let's move on over to dollar yen, and of course we'll start the analysis on the daily time frame as well. All right, okay, before that, for the dollar index, let me just see on the 4-hour time frame. All right, take note, I've got stochastic, the stochastic oscillator and RSI as well. And we can see here as dollar index was coming up towards 105.30, right, on Monday and again on Tuesday. We did see both RSI and stochastic highlight over bought conditions as well, right? So typically when you see RSI and stochastic both indicating overbought conditions, right? You shouldn't be looking to go long on any particular instrument, right? And in this case, it's a dollar index. So you're basically buying at the top, right? Especially for the 4-hour time frame, when we see stochastic and the RSI indicate potential overbought conditions, right? We're likely to see prices likely stall and pull back, right? If you had bought here, okay, maybe you would have gotten lucky and we saw a pullback before resuming the uptrend. But if you had bought here at around 105.40, this would have definitely been a trade that would have gone against us, right? So take note, whenever we see both stochastic and RSI indicate potential overbought conditions, especially on a 4-hour time frame, it's quite likely we have missed that move, right? We had missed that long opportunity, and it's probably time to wait and try and find another decent opportunity. And it could also help us identify a potential reversal as well, right? So as you can see here, looking at the 4-hour time frame, looking at stochastic and RSI, it doesn't seem to indicate oversold conditions just yet. So maybe if the data is going to come in and present itself to be a bearish catalyst for the dollar dollar index, we are likely to see it fall further, and we have yet to see the stochastic oscillator and RSI highlight a potential oversold conditions. Right, we can see here quite nicely on 3rd of June, Monday, 2 Mondays ago rather, we see the stochastic oscillator and the RSI indicate potential oversold conditions, right? And we did see dollar index find nice support at 104, consolidating around just above this level for about a period of a week before finally bouncing higher. So take note, stochastic, the stochastic oscillator and the RSI on a 4-hour time frame typically do help us to identify significant major overbought areas and significant oversold areas as well. Right? Okay, so that's what we have for dollar index. Now let's move on over to dollar yen. Right, once again, we'll start on the daily time frame. Before we get into stochastics and RSI indicators, let's just start our analysis based on Fibonacci retracements and significant supply and significant resistance and support zones. Now, this is a pretty decent resistance zone as well. This is like a I would say a pullback or multi-swing high resistance at around 157.87, right? We can even see here a nice swing high resistance taking place at the end of May, and of course this big strong move here as well, right? So I'm inclined to identify my first resistance for dollar yen at 157.87, and of course to identify the second resistance, it would simply be the top of this wick here at 160.23. Now, just to get some perspective on how strong this rise in dollar yen has been, let's switch on over to the monthly time frame. Right, we can see that this is actually a 34-year high. The last time the yen was trading around these levels was in April of 1990. So that's about 34 years ago. So we can see that it is not trading at the absolute all-time high, but we can see that it is trading close to a 34-year high. So very significant weakness for the Japanese yen. All right, okay, now let's get back down to the daily time frame. Okay, right, we can see a nice swing low as well that's occurred here, right, on at the end of December, early January. Another swing low here as well, a nice pullback here, and also another pullback here. So the uptrend, of course, we can see that there's still a strong bullish uptrend for dollar yen for most parts of 2024 so far. Right. Can I identify a bullish channel? Maybe there is one, right? Maybe there's a pretty decent bullish channel to identify. Yes, not too bad. This is not too bad. I think this is fine, right? It's good to get a good sense of where uh, the extremes of this bullish trend line lie, which also can help us identify potential resistance areas. Remember, the upper trend line of a bullish channel can help us identify potential resistance areas. Similarly, the lower trend line of the bullish channel can also help us identify potential support zones as well. Now, before I draw the Fibonacci retracement, I do see a very nice pullback support or multi-swing low support that's taken place at 154.87. We can see dollar yen bouncing on this level on 15th of May and the 4th of June as well. Of course, we have this wick here on the 16th of May dropping well below, going as low as 153.65. But generally, you can see, at least on the daily time frame, that this level here at 154.87 has functioned as a pretty decent pullback support. So that's where I would identify my first support level for the dollar yen on the daily time frame. Now, for the second support, we can also see a nice swing low that has taken place on the 3rd of May, right? As dollar yen pulled back very strongly. Remember, this was at the beginning of April where the Bank of Japan intervened in the open markets, and we had intervention action by the Bank of Japan, which meant they were buying back yen in the open market. And when that happens, that's going to cause dollar yen to pull back sharply, which it did for a period about a week. But then once the intervention measures had stopped, normal market forces came back into play, and we saw the dollar yen resume its upward trend once again. Now, because of this swing low here that has taken place on the 3rd of May, I would identify this level here as this level at 152.92 as the second support. Right. Okay, now we can draw a Fibonacci retracement, right? We can start the retracement from here. This swing low that occurred on 28th of December 2023, going up to this high on the 29th of April. Let's pull up all the fibs. Right, we can see that, of course, dollar yen has pulled under 23.6%. So this retracement level here at 23.6% is no longer valid. However, we do see it find nice support just above the 38.2% Fibonacci retracement. Right, so you can see quite clearly this is a pretty strong swing low support that has the presence of a 38.2% Fibonacci retracement. Now, we can also use the 50% retracement. Okay, I wouldn't use the 50%, but I can see a nice pullback support level here that's been in place since 31st of October 2023. 4th November, and also here in early March and March, early April. So this level previously, which is at 151.66, previously used to function as a pullback resistance, right? You can see resistance here in October 2023, November 2023, as well as and March, early April of 2024. So what was previously a strong pullback resistance level could now potentially function as support. So this is where I would identify the next major support level should we see the first and second be broken. But for now, we don't really need that. And we don't really need any other retracement level apart from 38.2%. Right. And you can also see here in yesterday's candle, looking at the 30-minute time frame, right? You can see that when the CPI data was released at 12:30 p.m. GMT time yesterday, we saw the dollar yen pull back as well. So the strong sell-off in the US dollar also negatively impact dollar yen. We saw it drop from about 157.14 to as low as 155.72. Right, so dropping almost about 140 pips, right, in a period of about 2.5 hours. Then, as FOMC, as the FOMC meeting concluded and the statement and press conference were released, we can see that there was a strong reversal in price, and in fact, dollar yen has actually recovered all its initial losses as well, or rather, it's recovered its entire overnight loss as well. Now, of course, we can also expect, or we can potentially expect dollar yen to pull back once again should we see soft CPI data and higher claims later today at 12:30 p.m. GMT. So take note, there's a potential uh, uh, bearish breakout, I would say, or bearish breakdown for the dollar yen should we see soft CPI and higher claims. Now, of course, the opposite is also true. Should the data work to be in favor of the US dollar, then of course we're likely to see dollar yen resume its uptrend. All right, okay, so let's start on the daily time frame. Okay, anything else I would highlight? There's another Fibonacci retracement that I can draw. This time from this swing low here on the 3rd of May, going up to the high on the 29th of May. There should be a 50% Fibonacci retracement that aligns well with the first support. And yep, that should be it. Yep. Right, okay. And oh yes, we can also draw one more retracement from this swing high on the 29th of April, going down to the swing low on the 3rd of May. There might be a 78.6 that we could use, I think. Oh, okay, it's just above 61. Where 60, I think 61 is still okay, 61 has been surpassed. Perhaps we can just keep 78.6 to give us an indication that this resistance level here also has a presence of a 78.6% retracement, quite close to it, right? It's not exactly at that pullback resistance level, but just to be aware that we do have a 78.6% Fibonacci retracement here, which in itself could function as a strong resistance zone as well. Right, okay, so these are the key levels for dollar yen on a daily time frame. Let's see if there's any need to fine-tune the analysis on the 4-hour time frame. No, probably not. Everything looks pretty fine. Looking at um, the stochastic indicator and RSI, we can see that for the dollar yen, even though there are many instances where we would see both the RSI indicator, or the stochastic indicator and RSI indicate overbought conditions, we can see that this currency pair can continue to climb higher, right? So it's quite hard to call the top on dollar yen, especially with the yen being so weak in 2024. However, on the flip side, when we do see the stochastic oscillator and dollar yen drop to extremes, it does indicate very high probability bullish reversals as well. So for the dollar yen, pay more attention to uh, a scenario where we have stochastic oscillator dropping below 20 and RSI coming close to 30 or even dropping below 30, because they do really have identified high probability bullish reversals or bullish setups as well. So you can see that it's occurred here on 3rd of May. It's occurred again on the 16th of May. And we can see it's also occurred here on the 4th of June, right? In these three scenarios, when you see the RSI drop below, when you see the stochastic oscillator drop below 20, you see RSI coming close to 30 or even dropping below 30, it does indicate very high, it does indicate strong oversold conditions. So that means this currency pair is likely to stabilize and stage a pretty strong rebound. So if you take note on the 3rd of May, as prices starting to reverse, right? So let's just say we bought it about 152.50. And we can see that going up to this absolute high, going up to 156.60. This is almost like a 400 pip move as well, right? Similarly here, 16th of May, the indicators highlight a high probability bullish reversal. And let's just say we picked up dollar yen at 154, let's just say 154, and you can see this time around going up as high as 157.50 as well. So about another 350 pip profit as well. Similarly here on 4th of June, picking it up at maybe about 155. This one's a bit more choppy, right? We didn't see that strong momentum or strong reversal as we saw on 2nd of May and 16th of May. This was a little bit more sluggish in the move, right? But generally, if you picked it up at 155, going to as high as about 157.20, so at least about 200 pip profit as well in this scenario. So do take note when on the 4-hour time frame, when the stochastic oscillator and the RSI indicate oversold conditions, right? It's quite likely this is going to be a high probability bullish reversal setup. All right, so that's what we have on the dollar yen. All right, let's move on over to gold. And of course, should you have any requests for any other currency pairs or the commodities or even the indices, please do drop your requests in the chat box as soon as possible, and I'll be more than happy to go through the analysis with you. Right, do not wait till the end to drop your request in. Drop it in the chat box as soon as you can, and we can go through the analysis together. Right, so similarly, looking at gold, right, with gold prices, let's see, right, with gold prices, with dollar index selling off sharply yesterday and then dropping, we did see gold spike as high as about $2,341 per ounce before pulling back as well, and it does look like it's continuing to fall today as well. Right, so similarly, should we see data that's going to be bearish for the US dollar, then quite likely it is going to cause gold prices to reverse and climb higher. Similarly, if we see tonight's data to be negative or to be positive for the US dollar, then of course we're likely to see the gold prices continue its downward momentum here. Now, I see a nice overlap resistance level here, right? I would like to highlight this as a intermediate resistance for gold on the daily time frame, right? You can see it $2,327 per ounce function as a strong support from 23rd of May till the 5th of June. And you can even argue here that yesterday it did find some resistance around this area as well. Right, so this is where I would identify an intermediate resistance level for gold at $2,337 per ounce. And the first resistance I'd identified at this pullback resistance that occurred on Thursday, which is at around $2,378 per ounce. Now, with regards to support, I see a very nice pullback support level here that's been in place since 30th of April. We can see gold has bounced off this level several times, which is $2,285 per ounce. And of course, as recently as last Friday, 7th of June, and Monday, 10th of June as well. This is important as well because with identifying this level as the first major pullback support is important because as markets reopen on Monday, we saw gold prices stall above this pullback support level, right? Or this was a swing low support back then, right? Remember, market structure here shows us a very nice swing low bounce and then a swing high here as well. So as markets bounce off strongly, making a swing low here in 1st of May, and with gold prices dropping sharply on Friday, 7th of June, right? This level should have been identified as a major support level. And especially as Monday markets open, we saw it dip a little bit lower, but gold prices then reversed to climb higher. So this tells us that there's a potential bullish bounce on hand, right? Might be a minor rebound, right? A minor rebound. And then because we had also identified this level here at 2,327 as a previous pullback support level. Remember, previous pullback support levels can then be used to be identified as resistance. So as gold prices bounced off a major support level and continued to climb higher, we would have started or would have initiated a long position for gold. And because we would have identified this level at 2,327 as a potential resistance area, a first take profit level for gold should have been around this region here. So that is why I say it's critical to be able to identify significant support and resistance areas, because it really helps us to identify the entry and exits for long and short trade opportunities. Right. Okay. We can also draw Fibonacci retracement. There's a few retracements we can draw. I would say the first one would be from this swing low here on 14th of Feb, going up to the all-time high. Take note, this is the all-time high for gold on 20th of May. Let's pull up all the fibs, right? We can see, right, we have a 38.2%. Okay, it's not exactly lined up at exactly where the pullback support at 2,085 happened, but it's good to know that there is a 38.2% beneath this level here. So let's just keep 38.2% and highlight it as a zone. Right. We can also run a Fibonacci retracement from this swing high here, or this all-time high 20th of May, going down to the absolute low here. I believe there's a 50 or 61 that we can use. Right. We've got a 61% Fibonacci retracement that aligns quite close, while actually hit the top of the wick here, right? So we can see that the 61.8 retracement level did function as a help us identify a very strong resistance area as well. Okay, actually this is actually after, but now we can see in the future, this pullback resistance level has further as an additional factor, which is the 61.8% Fibonacci retracement to identify a strong resistance zone. All right. And okay, so that's it on the daily time frame. What about on the 4-hour time frame? I think that's pretty fine, right? I think, yeah, this is pretty all right. So take note, right? So if we do see softer PPI and higher claims, this is going to likely to function as a bearish catalyst for the dollar. So that means we should see dollar fall, and that in turn is quite likely going to cause gold prices to rise. So we may see gold continuing its uptrend. And should it break above this level of $2,334 per ounce, it's quite likely going to come up towards close to the first resistance here at around 2,370 to $2,378 per ounce. Conversely, if you see data that's going to be bullish for the dollar, then quite likely, of course, we're going to see gold prices reverse and resume the downtrend, and where it could find strong support once again could be around this region of $2,285 per ounce. All right. Okay, so these are the key levels for gold. Oh, let's just check on the 4-hour time frame. Right. Okay. So for now, you can see sort of the stochastic oscillator and RSI, lying in around mid-range of their respective uh, zones, right? So it means there's we don't really have any indication of any high probability overbought or oversold conditions. So right now it's really literally in limbo, right? It could go either way. So it really depends on the data that's going to be released at 12:30 p.m. GMT later today. All right. Before we end today's webinar, right, I'll do one more analysis in a few minutes, but first I'll just launch a poll and truly appreciate it if you guys could give your feedback with regards to today's webinar. And then after that, we'll wrap up the session with one final analysis. I'll just keep the poll running for about another 10 to 20 seconds, and then we'll continue with a final analysis. All right. Okay, great. Thanks for the feedback. Truly appreciate it, everyone. Right. Just keep it running for another 10 seconds, and then we'll wrap up the poll, and then we'll start the final analysis. All right. Thanks, everyone. Truly appreciate it. All right, okay, let's wrap up with final analysis on oil. Right, so you can see here oil has made a nice swing low bounce here 2 Tuesdays ago, 4th of June. Right, so quite clearly this is a very strong support level here. We see one strong swing low here that occurred on Tuesday, Wednesday last week, and then another swing low support here on in early Feb as well. So this is a clearly like a multi swing low support level, very strong area. So this is where I would identify the first major support for oil, right? WTI oil specifically here, which is at $72.34 per barrel. Similarly, I see a nice overlap level here at around $80.60 per barrel. We can see multiple times where WTI oil has reacted off this level as a resistance and support. This is a very significant resistance level here at $80.60 per barrel here. Right, now we can draw Fibonacci retracement, starting from this swing high on the 5th of April, going down to this swing low on the 4th of June. Right, let's pull up all the fibs. And we can see that there's a presence of a 50% Fibonacci retracement that aligns very close to this overlap as well. So let's use 50%. Here we go, pretty strong resistance zone, right? And then I would say there's a intermediate support zone that I would like to identify at $76.20 per barrel. We can see that since 14th of February till the 24th of May, WTI oil has bounced off this level several times. It does indicate a pretty significant support level here. And one last final Fibonacci retracement. We can run from here, 4th of June to the high of yesterday. There is, yep, there we go, 50% Fibonacci retracement that aligns very well with this pullback support here. So let's keep 50. There we go. And maybe one final retracement from this swing low, 13th of December up to 5th of April. Is it a 61 or 78.6 that we can use? There we go, 78.6%, just nice with the first support. Right, so with gold, crude oil prices pulling back right after making this strong reversal here, perhaps should it find support at the 50% Fibonacci retracement, which is a pullback support at around $76.20 per barrel, potentially we may have an opportunity to go long on crude prices around here. So take note, if it does find support at around the 50% Fibonacci retracement and stabilize above this level, we may have a decent opportunity to go long on the dollar or on WTI oil. And looking at it on the for our time frame for stochastic and the RSI, right? We can see here, right over here with RSI dropping as low as 15 and stochastic coming as low as under 3. We can see that this setup here did help us identify a very strong bottom in WTI oil, identifying a pretty decent long opportunity as well. So should we see crude oil prices, WTI specifically, pulling back further, and at the same time we get the stochastic oscillator and the RSI indicate potentially oversold conditions on the 4-hour time frame, then once again we may have a good opportunity to go long on WTI oil once again. All right. All right, great. Thanks everyone. That wraps up today's session. Thank you all for tuning in. And do take note, we've got PPI data coming up today, along with unemployment claims at 12:30 p.m. GMT, and we've got the Bank of Japan tomorrow as well, right? So take note, if we see a soft PPI readings, right, actual coming in lower than the respective forecast, and at the same time, if we see claims coming in higher than 225,000, both of which are going to function as a bearish catalyst for the US dollar, then of course that would mean currency pairs like the Euro, Pound, Aussie Kiwi, along with gold are likely to rise. All right, that's it. That's all I have for today. Thanks everyone for tuning in. Have a great week and also enjoy your weekend as well. Right, take care, and I'll catch you all at the next webinar.